Hey everybody, Courtney Smith here with this week's edition of Wall Street Winners, and also with this week's edition of this disclaimer. Now, interesting, really interesting this week. Let me explain why. The S&P obviously had a great week 2 weeks ago, and then this week we kind of paused. And you can see that we paused where the previous high was. Now, you know, the basic definition of a bull market is making higher highs and higher lows, and the definition of a bear market is making lower highs and lower lows. And we were making lower lows and lower highs, so breaking above that horizontal yellow line would put us back into pretty much a bull market. We're not really making higher lows, but at least we'd be making higher highs. But I don't think that's what's going to happen. Take a look down at the bottom of the chart, and you can see that as the rally went on, the volume got less and less. And what you always want is you want volume to confirm the price action. And in this case, the volume did not confirm. It showed that it was a short covering rally more than it was a long buying rally. And typically those are short-lived rallies. Those are rallies that just don't last very long. And now we've run up to the old highs, and guess what? New selling is coming in. So to me, I think we're going to probably take a little dip this week. Let's keep on going here. The Dow Jones, one good thing is that the green line crossed the red line in the upper right-hand corner, and you can, which means more buying pressure than selling pressure. But notice both of them are going down. Both of them are going down. In other words, we have less buying pressure and less selling pressure, but fortunately, the buying pressure is greater than the selling pressure. The Nasdaq also faded before it got to that high that we made in mid-May, and it just started to fade. Notice that the purple predictor was bullish through that strong up move 2 weeks ago, but now the purple predictor is right on the price, which therefore means that it is neutral. Seasonality, neutral. Seasonality, we're now in a seasonally bullish period, and we're not really getting, well, I shouldn't say that. We had a very strong rally. So what am I saying? But nonetheless, we need to break out to the upside to keep on keeping the seasonality on track. This, of course, is a long-term negative. We got a rebound here, but we're still at a negative yield curve. So it's nice, it's cute, but I don't think it's important anymore for the simple reason that we've broken down and stayed below zero on the yield curve, which typically predicts a bear market about a year in advance. It could be as little as 8 months. That happened once, maybe 10 months, as long as 18 months, but on average about 12 months. So it broke down technically in March. So that would be next March, roughly-ish. Asset allocation. They moved. They kind of stabilized. There's a teetering here between moving money into cash or bonds. So in the strong up week we had 2 weeks ago, we came right back into the stock market, and then this week they kind of said, can't decide, so we'll just do nothing. Now the RISKDICATOR did go up a bit. Okay, now stop and think about this for a second. The stock market, you know, we had a great rally, but this last week it went sideways. But they were starting to move back into riskier stocks and out of less risky stocks. Global shares did pretty well, and then they faded this week as well. Bonds, however, and this, let's stop for a second here. Notice the purple predictor. I was worried before that we were making a failure top. That idea is still in play. But a break above the high we made last week would suggest that we're probably going to move to new highs and break above the highs we made on the very first day of June. And the purple predictor is starting to really be bullish there. So I think we really have to be looking at the bond market pretty bullishly at this point. Normally that would be a good thing, but it means that probably the yield curve will stay negative longer because as bonds go up, that means interest rates go down. Bond key factors still remain very bullish. with the exception of gold, which we'll talk about how about in just a second. So the dollar's mainly been under pressure here since the beginning of June until really Friday when it got a nice pop. But gold, it's been, of course, the opposite. And on Friday, it looked great early in the day, and then it faded. It still ended up on the day, but you know, it was really a microscopic move higher. Even though the market had been like $15 higher, $17 higher, it ended up only a couple bucks higher. Still, I'm bullish on gold at this point. With lower interest rates, that means the carrying costs are less. The dollar's generally under pressure. That makes gold worth more as well. Gold key indicators fading a bit here. So gold is fading a bit. We had the great bull run there, and now we're kind of going sideways. I wouldn't be surprised to see us consolidate those gains for a little while longer. So look for the gold market to stay stable right now, and then we'll continue the bull market in perhaps next week. Crude oil, I think, is also putting in a low here. We're starting to see more and more reductions of capacity, of production, I should say, in many places around the world. Obviously, Iran with sanctions, Venezuela is going to zero. We have yet to see an increase from the Mexicans with their new head of Pemex, and so on and so forth. So look for crude oil to start to be a little bit better off. Now, Bitcoin, last week I was like scratching my head, if you remember, and I was really, you know, I didn't say get out. We stayed long, but I kind of said let's be more aggressive at moving our stop loss up. And I told you about an extensive multi-year investigation that I had done and had come to the conclusion after this extensive investigative reporting that the prices would either go up or down. That's right. That's right. I know this comes as a big surprise to you, but my investigation shows the prices would go up or down, and I wasn't really sure which way they were going, and they went up. Wow, what an explosion to the upside. Look at the purple predictor. It's leading the market higher at this point. So we clearly have to remain on the bull side. Our stop loss should be below the lows that we made at around 74.74. So put a stop loss at, let's say, 74.69 on your long positions. But we bought this down around 4,000. We've made 100% on our money. So there's nothing wrong with that, all right? And let's stay long right now. The whole technical picture is much more bullish now. All right, that's it for me, freebies. Orlando and Las Vegas are our next stock financial freedom systems. Orlando is going to be a sellout. I'm almost certain of that. And our masterclass, don't forget that. Now, in the Option Success School, once again, Orlando is really filling up. We have not done an event on the East Coast for several years, and so there's a lot of pent-up demand. People are really coming in there. So if you're thinking of going, please get your tickets right away. Okay, and of course, I'm more and more worried with that incredible yield curve situation that we're going to have some type of definitely a bear market and hopefully not a crash, but we'll see. All right, freebies, that's it for me. Fully paid up members, hang on just 1 second.